Welcome to the Money to the Masses podcast, putting you in control of your finances. It's a good thing podcasts are free, as this one isn't worth a penny. Here are your hosts, Damien Fahy and Andy Leeks.
Now, Damien, before we get on with this week's podcast, you had something quickly to say about our sponsors.
Yeah, we've got a new sponsor, Money Farm, and Money Farm are an online investment advisor and one of the biggest digital wealth management companies in Europe. So a big thank you to them for sponsoring the podcast. Now, Money Farm create portfolios to maximise long-term returns using ETFs to make incredibly cheap portfolios. And you even get the first £10,000 of your portfolio invested without any charge from Money Farm. And if you enter the code MTTM20K into the box when you sign up, you get the first £20,000 of your portfolio invested and run by moneyfarm.com without any charge.
Great stuff. On with this week's show. Hello and welcome to episode 114 of the Money to the Masses podcast with your resident expert, as always, Damien Fahy and me, Andy Leeks. Damien, I'm feeling festive. How are you?
I'm feeling festive, Andy. I've been listening to Christmas tunes all day. I haven't been... Do you know what? Somehow I managed to not hear a single one for the entire week in the lead up to Christmas. And I've had my head down doing stuff, been out and about. And so I chucked on one of those albums that just plays all the classics. So I've been listening to that almost on repeat for about 5 hours. So I'm feeling very festive.
Beautiful. Yeah, me too. I've been out and about today with the family doing Christmassy things, and as this podcast comes out on Christmas Eve, hopefully our listeners are feeling pretty Christmassy too, although they may well be listening to this after Christmas. So if you did, happy Christmas. Hope you had a good one.
Yeah, and make sure you subscribe to the podcast on your new iPods or whatever you're using to be listening to this podcast. So how have you been this week, Andy? Because you've not been very well, have you?
No, that's right. Our whole family have come down with rotten bugs and diarrhea and all sorts. So we've been stuck in for about 5 days solid now. Today was the first day we were able to get out, which is why we took the opportunity to get out and about in the fresh air. But yeah, so we had our eldest came down with it first, then myself, then my wife, and then finally a day later my youngest came down with it. So yeah, pretty sicky household.
Yeah, we've got that pre-Christmas bug thing going around. One of my oldest daughter's got it, and it just seems to be passing around. You're trying to survive to the big day, so hopefully we manage it. But what have we got on the podcast? We've got this week, actually, I didn't want to bombard people with too much because it is Christmas and they might listen to this while they're in between Christmas dinner and rubbish jokes or whatever, and Only Fools and Horses repeat. So I've done something that's quite easy to consume, and it's a little bit of what happened last year and a little bit of what's might happen next year, and just something to look at or consider before we go into the new year, because the new year is actually the most popular and inadvertently probably the best time to be looking at your finances, because everything's geared up to it. Everybody's got their New Year's resolutions. We'll come back to more of this stuff in the new year, but it's just something to not to do anything, but something to just be aware of and look out for, just so you're ready for when you feel inspired in that new year period.
Good. Okay, well, we best crack on.
Right, we'll go with that last theme. And what I wanted people to think about is, don't do anything over Christmas to do with money, because unless you have to, of course, but there are better things to be doing than sorting out money. But one of the things that stops people when it comes to the new year to actually take any action when they look at their finances anyway, whether it's energy bills, whether it's to do with their mortgages, is the fact that once they sit down, they don't quite know where to start, and they don't have the information they need to get going anywhere. Now, we are at the point where everybody, or a lot of people, are going to start sending out statements. So I'm talking about banks, I'm talking about energy companies, they're going to be mortgage companies. You're probably going to start getting annual statements for different things. And now, most people will just take those things and shred them. Or if you've got paperless bills, then you're probably going to get an email with this stuff on. All I want people to try and do is just to file those in somewhere where they can get them in the new year, because they will actually help them to cut down on any task they want to do. So I'll give you an example. I've just had an email from my utility company with my usage for the year. And most people probably just delete that or throw it away. But actually, that's probably the most useful thing you can have if you're trying to cut your energy bill, because it gives you an actual summary across the year of how many kilowatts of energy you've used, etc. And so when you go to comparison sites, rather than try and estimate what your energy usage is, if you're trying to get onto the cheapest electricity or gas bill, you can put in an exact annual usage, and therefore you can find the best deal. So that makes that task become a almost 2-minute job, rather than you trying to estimate or use various different estimations or tools to work it out. So when you get these statements, keep them and put them to one side, because when you come back in January and you want to look at these things, it saves you hunting around. And so another example is your mortgage statement, because then you can see how much you've got outstanding. There was a bit of research actually that was, I think the figure was something like about 70% of people, actually it was 80%, don't know how much they still owe on their mortgage. And so just have a look at that figure when you see it, just so you know in your head roughly, round it up so you know how much you still owe on your mortgage, because then now is about the best time you're ever going to get to remortgage, because rates are so low. I'm not saying that rates are about to shoot up, but the best mortgage deals are starting to be pulled. The cheapest ever fixed rate mortgage has actually been pulled in recent weeks. So I'm just saying to people, look at this stuff just so you can see where you are, and don't necessarily have to do anything. Then the other thing is to think about, if you've got a will, have you got a will in place for your kids? It's all great when you see your families at Christmas and you think about how wonderful things are, but have you actually got anything in place to quickly look after them? So a will, because obviously if you die without one, then your estate will be distributed in accordance with the rules of intestacy, which probably won't be how you want it to be. And also, there's nothing in place to say where your kids will go, who will look after them, which your will do. The other thing I'll just quickly mention, by looking at how much you owe on your mortgage, you can also think, have you got life insurance in place? And they're the life insurance and wills are the two simplest and probably the first port of call of any financial planning. When you go into the new year, if you can sort those out, if you can tick those boxes to say that you've got enough life insurance to cover at least your mortgage if you die, so your family aren't turfed out on the street in the middle of the winter, or that you've got a will in place so people are looked after, or you know who is going to look after your children if the unfortunate circumstance that both you and your partner die or something like that, then Christmas is quite a good time to sort of think about those things. So just think about it, plan it for the new year, just get that stuff filed away to one side where you can find it and you can take some action. So enjoy your Christmas. Don't think about money, but just don't ignore those bits that come over. I think they probably send them to you because most people just ditch them, and they probably think the utility companies, then most people don't actually do anything with those statements. But plan to do something in January. So that's my little bit of advice for Christmas.
Good. Bit of housekeeping for now, and it's going to pay dividends in the future. I'm going to do exactly that because it's time for me to switch on my utilities. I haven't switched for a couple of years now, and my latest bill was nearly £400 for the quarter for gas and electricity. To be fair, my wife has been putting the heating on every single day, but that's too high for me, so I need to start to switch.
But it's just one of those things, you just flick it somewhere on your email, chuck it in a folder. It's that, yeah, I'll sort that out. But at least if you do it, that's one step, and it makes it easy when you finally do get round to it. Because we're realists, aren't we, Andy? We know that people don't obsess over this stuff, and we'll do it every day. I've got better things to do during Christmas. Mine is just to probably survive Christmas, to be honest with you, going to see sort of family driving around the motorways and all these sorts of things, to then worry about money. Right, that is a bit of, that's kind of the now. I want to do a little bit about the past in 2016. Now this next two pieces have got an investment focus, but there is slightly general coverage of investing in 2016. So even if you're not massively into investing, then you're going to learn something here. Right, 2016 was the worst year since 2007 for fund management. So mostly active fund managers. Now, if you don't know what an active fund manager is, though, when you invest in your pension or you have an ISA and you will typically buy a fund that's run by a manager who will invest in all sorts of things, whether it's shares, bonds, or whatever, and then you give them your money and then they invest it accordingly. But you can have lots of different funds, and there's thousands out there. But of course, these guys are paid very well, and they actually take a fair bit from your portfolios to pay for it. Normally, sort of between 1% and 2% every year. But of course, there are these things called passive investments, which are just pretty much run by computers that might track indexes or the market. And this year, 2016, was apparently the worst year since 2007 for active managers, meaning that they were rubbish. They did a bad job. They struggled. And to give you a good example, 21% only 21% of fund houses beat their benchmark. Now, their benchmark it's a bit like a football manager turning around saying they're going for a top 4 place, a top 4 finish, or whatever they pick it is. So it might be the FTSE 100 is the benchmark for the fund manager, but they set what they're trying to beat, and they haven't done it. And so that, by comparison to the previous year, so 2015, 72% of active funds did beat their benchmark. So you can see that 2016 was the year they want to forget. And a brilliant example of how bad it was for some of them is there's a guy called Neil Woodford, and if you listen to this podcast, you may have heard me mention him. He's like a living legend by most people's measures in the investment world, and he's one of the few managers who over the long term has outperformed the benchmarks and everybody else, and he made 2% this year. And bearing in mind that the equivalent of probably what he should have earned was at least 4, he's really underperformed. And to give that some context, we did the 80-20 Investor, and I run £50,000 on 80-20 Investor, as you know, Andy. And in our year, my portfolio's up almost exactly 13% in that 12 months, which I'm obviously really pleased with. And so it's been a good year. But what it goes to show is that even in a year which is terrible for active fund managers, then you can still make money. And the point is that every dog has his day. So we think about Neil Woodford there. He is, over the long term, he has managed to outperform, but he's going to have periods where he does underperform. And so therefore, why invest in him? Invest in somebody else. In 80-20 Investor is all about trying to identify those managers that may outperform or may do well going forward, so you can pick them. Hindsight is wonderful, but investing is about investing going forwards and trying to pick them. So in the new year, obviously it's a good time to sort of get your house in order and think about investing. And so there, obviously everybody can get a free trial of 80-20 Investor. We've had such great feedback this year. But going back to this point, is the takeaway from these stats on this year is that yes, every dog has his day and every dog doesn't, so therefore, in the case of Neil Woodford, he's underperformed. It is still possible to perform well. You just need to know how to find the managers that might outperform. So then the next thing is that, obviously, Neil Woodford just invests in shares, UK shares, whereas when I do my portfolio, I invest in all sorts of things, bonds, shares. Shares typically have only been up to about half of what my portfolio is worth, so 50% of it. So it shows about diversifying overseas, the benefit of doing that. And where I want to just sort of round this up is that people therefore say, does that mean buying passives is the best way? It's the only way. You get lots of people out there who bang on about, ditch active investors, active managers because they're just profiteering from you and they always underperform. Yes, most of them do, and lots of them do, but they do periodically outperform. They do for short periods of time. The big debate is they say you should buy and hold one or the other. That seems to be what it's based upon. That's nonsense, because why would you buy and hold any of them? Because ultimately, like I say, they will underperform for periods of time, so you want to move between them. And obviously 80-20 Investor was my way of empowering people to do that. So in my portfolio, I hold trackers within it as well as active funds, so it's not a case of one or the other. You can have both and you can blend both. So that's the message I want to get out there. But one of the things I just wanted to point out, that 2016 was a good illustration of why occasionally active managers do underperform en masse. And we had a couple of big events. We had Brexit, didn't we? We had Trump winning the election. And generally speaking, if a market suddenly changes direction and we have something that's very positive, which people didn't think it was going to be, Brexit or Donald Trump winning the election, when something becomes suddenly incredibly positive, index trackers and that will suddenly will rally because the market has suddenly turned on a sixpence and it will take off. Ahead of those events, these events, and I'm going to come on to what a general term about for these events, which has been coined, and it's something new I want to explain to people. It's called grey swans. So don't worry about that for now. It's a new thing I'm going to teach you, Andy. Grey swans. And it was an event that was people had almost planned for and feared. So active managers, decided to moved their portfolios to protect any losses. Of course, what happened, the market didn't plummet like they thought it would, so it rallied and took off. And so they underperformed because they actually were too defensive and they couldn't play catch-up. And there were two big events this year, which is quite unusual, which is why they did underperform. So going forward, it was a good year for trackers for that reason. And the other reason that people overlook is that if you look at why trackers tend to do well, they tend to focus on the main indices. So they tend to focus on things like the FTSE 100 companies rather than some of the things that are lower down. So the smaller companies, the FTSE 250s. It's true across the board, whichever geography you are, whether it's in America or whether it's in Europe. And of course, what happens is in these instances when the markets rallied, it was these big companies' shares that really rallied. So the big indices, and indexes tend to be skewed towards those in terms of the trackers. Fund managers, where they're trying to add their value, they tend to go fishing outside of there, if that makes sense. So they go down to try and find the next big thing, the next company that's going to blow up and make lots of money and the share price rocket, because that's how they add their value. So over the years, they go fishing lower and lower. Neil Woodford's a good example. His new fund actually goes down that sort of area. So in a year where small caps or fishing outside of the really big obvious names hasn't actually done very well, then that's why they've underperformed. So it's very simplistic when people just take something like last year and just go, that's it, only buy index trackers and ETFs that do these things. That's very simplistic. You have to understand why they didn't, why they did outperform and active fund managers underperformed. And going forwards, I think it could change, but I think we could have a period where active managers do outperform because of this change in dynamic. The large stuff, the big names all rallied. You saw the FTSE 100 do quite well and the S&P over in America. That could change because going forward that isn't sustainable. The rally was that big. The other quick thing I want to say before we finish on it, Andy, is that they tend to, because index trackers tend to track the index, they never outperform the market anyway. They're always going to be below it because they buy the market and then they charge you a small amount. So you aren't going to outperform the market. Although the fund managers underperform the market, your tracker will do too. It's just the managers did it by a bigger extent when they were taking their bets and got it wrong. But there is this thing about the bond market, which was a big thing this year. So imagine that investment bonds were seen as the low risk end of investment, and that's where people put their money as the core part of their portfolio and then did the stuff around the outside like shares. Well, the bond market kind of collapsed towards the end of last year, and if that is something that becomes a big theme of 2017, if something like that starts to unfold, some of the trackers will just track that down, if that makes sense. They can't suddenly slam on the brakes and go, whoa, we don't want to buy bonds. It's because it's written in their prospectuses or whatever indices they track, they go down with it as well. So the one thing active managers, the time they do tend to do well, which all the studies have shown, is that if markets start to go downwards or we get periods where there are losses, they are better at controlling those losses, yet they may, as I've just described earlier, lag if the market suddenly rockets upwards. So if we're going to get a period in 2017 when markets go downwards, then we may be having a conversation next year where active managers have done better. So I hope that all made sense, but it was just a bit of a look back at 2016 in an investment way that to explain what happened, maybe chucking it towards 2017 and what the outlook might be. So there you go, and a few lessons in the mix as well.
Good. And grey swans?
Grey swans, right. A grey swan. Have you ever heard of a black swan, Andy?
Yes, I've seen many. I'm a member of Leeds Castle and I go there very often, and they're very famous for their black swans. So yes, I'm aware of a black swan.
So the black swan idea was, it was a famous book. It was written by, I can't remember the guy who wrote it, but the idea is that in the world there are white swans, and you see obviously lots and lots of white swans. In a sense, a black swan shouldn't exist. It's the complete anomaly that a black swan would even be in existence, because obviously all swans are white. Well, that was the assumption because that's all you've ever seen. And of course black swans do exist, and so when they obviously people came across them, they were sort of kind of blown away by the whole thing, and it's something that shouldn't happen but does. In the investing world we have the same thing, and the idea is that you can't predict a black swan. So you could be trundling along. The financial crisis, for example, was a black swan. Everything was trundling along fine. Everybody thought it was everything was wonderful. Markets were going up. There were things they were worried about, and certain things in investment markets they were looking at the time, but something comes along that nobody expects and just knocks everything for six. Everything you had based your theories upon, for example, that swans are white, then this black swan event came along and just knocked, and we're still recovering from that now. So black swan events can't be predicted, and their impact is incredible and normally sends markets spiralling into sort of huge losses and shakes things up. Now we've got a phrase that was coined recently, I've only seen it a few times, called grey swans. And you can imagine a grey swan probably would be a merger of a white and a black one. And the idea being that a grey swan event is something which you expect, it's unlikely to happen, but it would have a big impact if it did. It's outside of the usual sort of base cases, but you are aware that it might happen. So Donald Trump winning the US election was technically a grey swan by what this new phrase is. It was something that we were all mindful of, that was a possibility. Most people dismissed it completely out of hand. It was never going to happen. But we all knew Donald Trump was running for election, and it was a distinct possibility, despite the fact that most people thought it wasn't going to happen. So that's the idea of a grey swan. It isn't going to catch you by surprise when it happens, but it is because it is a kind of a known possibility. It will still surprise you and be impactful. And I suppose the reason I wanted to bring it up is that there are going to be grey swans going forward. And the grey swan was probably what hit active managers. They kind of overcompensated for the possibility of what was going to happen in markets, and it never did really happen. And that's why 80/20 did so well, because it's based on algorithms and it's based on a process. We were buying things that could feel really uncomfortable going into Brexit and when we went into the US election, that actually helped because we weren't being emotional about it. And of course, managers are emotional. So going forward, the reason I wanted to mention the grey swan was because you may hear more about it, because next year we've got a few grey swans that are out there. So things that we might want to, like themes that might happen that could rock markets, and we're probably a little bit more mindful of. So I'll give you a quick example. One grey swan that I saw mentioned was the fact that we could stay in Europe and effectively rejoin it post-Brexit. Now, all you people out there who voted for Brexit will be screaming at the podcast, but this is a good example of a grey swan, because this year we didn't expect Brexit to happen, and it did. Well, equally, a grey swan could work the other way around, where actually somehow we all decide the referendum is overthrown, and Theresa May and co decide that actually there's a better way to go, or even Europe, the EU turns up at the table and comes up saying, I've got a really good deal for you, please stay in the EU, and we do. So that would be a grey swan. So there you go, Andy, grey swans.
Good, lovely stuff. What we got next?
We haven't, Andy, because that was our three pieces, but one thing I did want to talk about going into 2017 is something to look forward to. And I mean, in the background, Andy knows about this. Obviously, our podcast is incredibly popular. And one of the things that I've been conscious of is we do investing, we talk about everything to do with money, and people enjoy it. But one of the things that I wanted to do is inspire people to do something different, to take a bit of a leap of faith. And with what you've done in life, Andy, that you've gone and written books that suddenly become major bestsellers, and you've topped Amazon and stuff like that. It's actually following your passion or a leap and doing something where you could have not done it. And Money to the Masses was a similar thing, as you recall, back when 6.5 years ago, when I decided to just start doing this. I didn't know why I was going to do it, and started writing, and then it's just blown up from where it was in those days. And now obviously it's a podcast, a website, books, and investment stuff, and we have obviously a big sway, and we have millions of people a year come and consume what we do. So I mentioned it a while ago that there's a new project in the background, and I'm just going to tell people what that is so they can get a bit excited. And we could do a drum roll, but we've probably got Christmas music already this podcast, haven't we, Andy?
We can do a drum roll, not a problem.
I'm building this up. Basically, what I've done is I've gone out there to find people with amazing stories that have taken a leap of faith and followed something, and wanted to, and it's been the best decision ever. So Money to the Masses would be an example where I just did something people didn't necessarily believe, and we went with it. But to inspire ordinary people who would listen to this podcast, that you could really go and do that. So that idea, maybe you decide you want to start baking cakes, you quit your job and you're going to do that and turn it into a business. It's to inspire people by hearing others' stories, other people's stories of how they've done it in business. And we've actually gone out there and lined up a whole host of people who run businesses. And I'm not going to tell you who any of them are. You'll find that out in the coming months. But there's some good ones that we've got. People who run businesses that you will have heard of. Some that have appeared on Dragon's Den and things like that. That we're going to hear their story, the story behind how they did it, why they did it, their sort of mistakes and the sort of advice they'd give people. Because we really want to inspire everybody out there that you can change your life by just following something. You don't have to have lots of money, and it's like you, Andy, somebody who did something, followed it, and you can achieve something that's really incredible. So we've got some really good stories on there, and so I'm looking forward to that. That will probably come out in January/February, and so there we go. I've let the cat out of the bag.
Exciting stuff, and that'll be coming through this podcast feed.
I haven't decided how we'll do it. It may be, but we might end up having a separate one. We might be this one. I haven't decided. I'm just excited about getting the people on board to interview, and we've already done one or two of them, and it's good. So the people are amazing. When you hear the characters behind these businesses and some of the sacrifices they've made and the fun along the way, you realise that it's massively inspiring. So it could be by this feed. I don't know. We'll tell you more details when we get nearer the time, and of course it does mean even more work for poor old Andy, who does all the work behind the scenes to help all this stuff happen. So there you go, Andy. He's probably looking at me saying, "You what?" But yeah, he knows this anyway. I
do know, indeed. No, I'm really, really looking forward to it. And actually, as much as I love doing the podcast, the editing side of it is kind of like an extra job for me, because I have to listen to myself again. I've already heard the podcast once. I like doing editing where I'm given the audio where I haven't heard it recorded for the first time, because you're hearing it for the first time, and it's an interesting listen, and anyway, it's a slightly different job, and I'm looking forward to doing that.
So that's 2017. It's going to be exciting. There's a lot of stuff we're going to do in 2017. I know there's stuff that Andy's working on, which you'll probably hear about, that's going to be very exciting in 2017. So yeah, listen to the podcast. Have a good Christmas. Don't think about money too much. Have a great new year, and just be inspired of what you're all going to do when you go back in the new year. If you hate your job, then you got to make changes, haven't you, Andy? And it's kind of trying to get people to do that. You're in control of your own destiny, is what we're trying to say.
You are indeed, and who knows, because Christmas is coming up. Christmas is absolutely great for being given gifts that help you follow your passions. If you're an artist, you know what it's like. If you like doing a bit of art, all your children and family end up buying you pastels and all the stuff to do with doing art. So why don't you use that this Christmas to follow your dreams and take it that next level, and maybe start displaying some art and selling some art, and do what Damien says, follow your dreams.
Yeah, and it's an amazing thing when you hear some of these stories. I'm dragging this point on, but there were some really incredible ones. People who started doing baking and running it in a business, they've been inspired by like the idea of kind of like in baking, and the next minute they're being stocked in Harrods. And that idea, you can do it. And I just want to inspire people with other people's stories, because it's evidence that it works. So anyway, have a good Christmas, everybody. Have a good Christmas, Andy. And we'll see you on the other side in 2017.
Good. Looking forward to it. Have a great Christmas, everyone. Damien, back to you. Have a great one. I'll see you on the other side.
Yeah, see you later, mate.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.